Okay, welcome everybody. In today's webinar, we're going to talk about the double dose of events that we have tomorrow: the European Central Bank's decision and the non-farm payrolls, and how it affects euro-dollar. Now, these are the biggest events that affect both currencies. European Central Bank decision is always on the first Thursday of the month, or almost always, and non-farm payrolls is on the first Friday of the month. Each one has the biggest impact on its respective currency, and due to the 4th of July holiday, they happen at the same time. So the ECB press conference begins at 12:30 GMT at the exact same time when the US non-farm payrolls are released. And the ECB makes its decision 45 minutes earlier, but we don't expect any change in policy, so the big event is, of course, the press conference. Okay, let's start. I'll make a short presentation of myself. My name is Yohay Elam. I used to be a retail trader and a computer programmer. I founded Forex Crunch in the late days of 2008 during the financial crisis. Focus of the site is on fundamental analysis, but I also touch on technical lines. I see them as good for entry points. Anyway, this is how my website looks like. And let's begin. Let's see what we'll cover today. We'll talk about the current situation in euro-dollar, and then discuss what the ECB did last time, and it was quite a lot. What Mario Draghi, president of the ECB, could do now. Then we'll move on to the other side of the pond, talk about the state of the Fed, what the Fed is doing and what it plans to do as a preparation for the non-farm payrolls preview. And we'll also discuss 5 scenarios for what will happen with the non-farm payrolls. And of course, questions and answers at the end. Okay, so this is how euro-dollar looks like. As we can see, it's been recovering, and it fell as low as 135 in the last ECB meeting in early June, after deteriorating quite slowly. And since then, it has recovered, just touched 137. And now again back to around 136.50. Lines that I see are 137, 136.50, 136.15, 135.85, which is an important line, and 135.60 and 134.75. So what did the ECB do last time? Well, it did a monetary blitz. It cut the interest rate from 0.25 to 0.15, and it set a historic negative deposit rate. Banks are basically punished for depositing money. Now, contrary to what you see in this protest banner, nobody's arresting any banker, but the banks are, if they deposit money with the ECB, they have to pay the ECB. So this is supposed to make them lend out money, or at least send their money overseas and weaken the euro. Well, that's what the ECB would like. In addition, the European Central Bank introduced a neutralization of the S&P bond buys. This is a legacy program intended originally for Greece back in 2010. Now, for every euro the ECB invested in bonds, it drained €1 out of the markets. So it stopped sterilizing this. That means that more euros are available in the markets. This is a very, very weak form of QE. The sum there isn't that high in relative terms. In addition, it offered what it called TLTRO, or targeted loans. They're going to be available from September. It means that banks are going to get cheap money from the ECB only if they lend it out to the real economy. And later, not in the ECB press conference, but Draghi said in an interview that he hinted that rates will stay low until the end of 2016. Now, the Fed is expected to raise rates somewhere next year in 2015, so this is a dovish hint. But on the other hand, Mario Draghi did something quite different in that press conference. He changed the forward guidance of the European Central Bank. Before that, he said that rates could go low or even lower. Indeed, they went lower. But now he said they won't go lower. They will just stay in their current low levels for a long period of time. So, and he also said, answering to a question of a reporter, that rates have reached a lower bound. So if there is no threat of even lower rates, that was a positive sign, and this change in forward guidance basically balanced all the ECB's actions in terms of euro-dollar action. That means after we saw a fall from around 136 to 135, we saw euro-dollar recovering, and we didn't see the desired effect on euro-dollar. We'll talk later about why the ECB wants a weaker euro. And after Mario Draghi closed the door on more rate cuts, other sources, unnamed sources, said that it still could be possible, and that weighed a bit on the euro. We'll talk about that as well. Okay, so let's see the background for the ECB decision. Basically, the European Central Bank has only one mandate, an inflation level of 2% or a bit below. Now, it's missing this target for month after month. We have low inflation for a long time. That means that the debt burden is becoming heavier. That means there's a danger of deflation. That's what happens. What's wrong when prices are falling? Well, if we pay less for goods we buy, that should be a good thing, no? But if they fall consistently, then consumers, we expect them to fall even more, and then we don't buy. So factories produce less, people lose jobs, and there's less consumption. And the economy enters a vicious cycle. Now, this is not only theory, it happened in the Great Depression back in the 1930s in the United States, and it happened in Japan just in the past 20 years or so before Shinzo Abe was elected to the Prime Minister of Japan around a year and a half ago, and he changed the whole picture. So when there's this mentality of falling prices, it's bad for the economy. The ECB doesn't want that. So what are the numbers of inflation? The big deterioration of inflation began back in October 2013 with the fall of headline inflation down to 0.7%. That's quite far from the 2% target. Now, the ECB reacted quite immediately with the rate cut in November to 0.25%. It was 0.5 beforehand. And inflation continued falling, reaching a bottom of 0.5 back in March, and this was repeated in May and in June. Now, core inflation, what usually the Fed looks at, fell already twice to 0.7%. In June, according to the initial numbers, it rose to 0.8, but it's still very low. So if the ECB prefers leaning on core inflation rather than its mandate, real inflation, then it's also missing out on the target. So this 0.5 level has been revisited again in May and in June. In June, a month ago, the ECB performed this monetary blitz we just talked about. But things aren't moving that fast in the inflation battle. So what's the ECB's approach to deflation? Well, as we can see in this nice painting, denial. They deny that there is a danger of deflation, but they do warn that if this low inflation, as it's called, the low level of inflation, stays for too long, it is dangerous. So eventually, they did begin talking about the connection between the exchange rate and monetary policy, and they did perform this monetary blitz 1 month ago. Now, why is the exchange rate important? It's important for us, for traders, but it also has effect on the real economy. A strong euro means that its European exports are less attractive, and it also makes imports cheaper, pushing prices down and perhaps too low. So the euro has been too strong against the US dollar. Anytime it moved towards 140, this triggered comments from the European Central Bank about more action. But it's not only the US dollar that all of us care about, but also the Chinese yuan. China is a big trade partner of the Eurozone, and at the beginning of 2014, the Chinese authorities began weakening the currency against the US dollar. So if the yuan is weaker against the US dollar and the US dollar is weaker against the euro, that means that Europe has worsening trade terms with China. Chinese imports are cheaper and exports to China are less attractive for Chinese buyers. So that has been a very great concern as well. So in the past month, where's the euro? It is stronger against the US dollar. It didn't, or basically the same, it didn't go lower, it didn't fall It's trading now above 136, similar to the level seen before the ECB meeting. And of course, also against the Chinese yuan. But thankfully, luckily, it's weaker against the others, but this is not so significant. Now, the British pound, which had an amazing rally, and it's going on today as well, is significantly stronger against the euro. But and Britain is a trade partner, of course, of the Eurozone, but it's not as important as the United States or China. So, what do we expect the ECB to do now, tomorrow? Well, nothing. They made such a huge move back in June. So now in July, they will not make any change to monetary policy. If we see any change, it will be very surprising. I don't think we'll see anything. But the ECB does have its press conference. Mario Draghi meets the press, and that means that he will say something. So he may talk in three levels. First, the last tool that the ECB has in its shed is QE, quantitative easing, printing euros, enlarging the ECB's balance sheet, spilling euros into the Eurozone, and devaluing the currency. That would help. Okay, and he can talk about accelerating the work on QE. Another thing is to talk down the euro directly, and the third thing is to reopen the door to more cuts, what he closed the door onto last time. So let's see the three possibilities, their advantages and disadvantages. Now, QE is a huge tool. We have seen the effect, how it weakened the US dollar in the US. It did the same for the pound in the UK, and also the monetary blitz of the Bank of Japan from April 2013 also had a huge negative impact on the currency. So that's an advantage. So just talking about quantitative easing can weigh on the euro without any need for action. The ECB still has a few good months to talk about QE without acting, and this can weigh on the euro. The disadvantage is the ECB doesn't really know how to do it. Contrary to the US, the UK, or Japan, there's so many countries, 18 countries in the Eurozone, so the ECB faces questions such as which bonds will it buy? German ones, Greek ones, Portuguese ones, Finnish ones, it's complicated. In addition, the German Bundesbank, the German central bank, which is an important factor in the ECB, is against such a move, and this could be deemed as illegal in the German Constitutional Court. So I think the ECB would prefer not to use it. Maybe just talk about it, but not to use it. Okay. The next thing the ECB could do is talking down the euro. Say that the euro is a problem, the strength is a problem, and we need to have a weaker euro in order to fulfill the mandate of higher inflation around 2%. Expressing concern about the value of the euro can have a negative effect on the euro. I think the ECB could do it. Mario Draghi could walk gently along the line. The disadvantage is that, the G20 agreements forbid such a bigger-than-neighbor intervention to weaken the currency. And so far, the ECB also said that it's not targeting the exchange rate. So that would be a significant change of policy. After each time, Draghi says in the press conference that it's not a target. So I think there's a higher chance that the ECB will do that, even though it'll make some of their partners a bit angry, and even though it's a change of policy. But I think if push comes to shove, if the ECB is far from achieving its mandate, we could see that happening. Sorry. And the last tool that the ECB has to reopen the lower rates, the option for lower rates, I think they won't do that right now. Why? Because they just changed the policy back in June. So it would be a big U-turn. It would damage the credibility of making such a quick change. And it could also, another disadvantage is that it could be seen as a substitution to QE. And QE is a bigger tool than an interest rate of 0.05 instead of 0.15, or a negative deposit rate of 0.20 instead of 0.10. So I think the ECB and Draghi will avoid changing guidance on this. They might do it in 6 months or so, but not at the moment. So what Draghi could do, what he did last time, is that they say they won't lower the rates, but they could just adjust them just a bit or something like that. But in general, I don't think they will change policy on that. So let's sum up the ECB part. We expect talk, no action at all. QE talk and euro rent are most likely, especially to accelerate preparations for QE and to complain about the value of the euro. The desired outcome for the ECB would be a weaker euro, but it depends a lot more on the flows. Let's talk a minute about the flows. The Eurozone enjoyed flows from China and from other countries buying peripheral bonds. Spanish, Italian bonds have really high yields, had really high yields, and the stock market valuations were also cheap. So money entered the Eurozone and it pushed up the value of the euro. However, yields are already quite high and it isn't so attractive. And we've seen some reports from some banks that money is already beginning to leave the Eurozone. At the moment, it's still dripping out and not a big effect. Well, we see euro dollar is not weaker, but actually stronger. But we do see the euro a bit weaker against other currencies. So the ECB, if it talks now, it could just go with the flow. It could desire a weaker euro and actually enjoy a weaker euro thanks not to its words, but to the flows. So that makes a chance of talking higher. The ECB would like to ride on success and not try to fight stronger forces at this time. Okay, now let's cross the Atlantic. Let's see if we have, look quickly if we have questions about this part before moving to the second part. Yeah, it's a race to the downside. All the countries in the world want a weaker currency, not too weak, but to make the exports more attractive. So we had a QE in the US, in the UK, in Japan. We have a peg in Switzerland of the Swiss franc to the euro. So far, Europe hasn't really participated in these currency wars. And by not participating, it has lost. The euro is relatively strong. But well, we might see a change now. Now let's move on to the quantitative easing, the biggest one probably in the United States, and what the Fed is doing right now. So the US Federal Reserve began tapering quantitative easing, began tapering bond buys back in December 2013. It cut it down from 85 billion per month to 35 billion at the moment, 5 taper events. And it's on course to taper each meeting. Next meeting, I think, is at the end of July, with no press conference, and a more important meeting is in September. And in October, before the October meeting, QE will reach, according to the current trend, it'll reach only 15 billion a month, and it'll be cut down to 0. There is a small chance that the Fed will cut it down from 15 to 5 and finally end QE in December, but that does not make a big difference. The big question remains interest rates. When will the Federal Reserve, when will Janet Yellen raise interest rates? They've been low for over 5 years at rock bottom levels, 0 to 0.25. And there's been lots of speculation about raising the rates. Currently, the market expects them to rise in the third quarter of 2015, around a year from now. Janet Yellen brought these expectations forward by saying that considerable time between the end of QE and a rate hike would be 6 months, but later she sort of took back this comment. So it's still the third quarter once again, and that's what the market is looking at. So let's talk about growth in the United States. The Fed anticipates 2.2% growth in 2014 on average. In the recent meeting in June, the Fed lowered the growth estimates due to weak growth in Q1. And since then, we saw a revision of Q1 down to an annual level of 2.9% at a contraction. So with such a huge drop in production in GDP in the United States in Q1, it'll be very hard to achieve 2.2%. But if we look at all the other figures coming out from the world's #1 economy, the picture is a bit different. It's a bit more positive. The GDP figure seems like an outlier. Let's see. Jobs, which is tomorrow's report and the most important thing. So we had 4 consecutive months of job gains that were above 200,000. That 200,000 is the sort of unofficial benchmark for the Fed and for economists to see a growing job market. These 4 months were May, April, March, and February. February and March are in the first quarter. So we had a somewhat weaker job growth in January, but it wasn't that bad. It was above 100,000. In addition, we have the weekly jobless claims. After some period of jumps, they're very, very steady around 310K. This is a low level. It means the unemployment is falling. We've also seen a consistent drop in continuing claims down to around 2.6 million. It used to be above 3 million, and it has been going down quite consistently. This is a figure released with the weekly jobless claims. Now, the jobs figure that the Fed likes most is JOLTS, the job openings. Forgot the other letters there, but anyway, this was under 4 million for quite some time. It advanced nicely to this level and recently jumped to 4.45 million. JOLTS are released with a delay. That means now we get the non-farm payrolls for June, the beginning of July, and only at the beginning of August we'll get the JOLTS figure for June. The next JOLTS will be for May. So, but anyway, even if it's sluggy, it reflects the economy in a better way, the job market in a better way, according to Ben Bernanke. And also Yellen is looking at the exact same thing. What the Fed doesn't believe in is the unemployment rate. It already dropped to 6.3%, under the previous threshold of 6.5. The Fed's forward guidance, which it canceled Yellen canceled in her first meeting. Why doesn't the Fed like it? Because the participation rate is quite low. It's around 63%, significantly lower than before the financial crisis. Now, there's the generation of baby boomers, which is retiring, but it's not the only factor behind the drop in the participation rate. Another factor is that people are just discouraged to look for a job. The real unemployment rate, or what's called real, U6, is still around 12%. So the Fed doesn't really believe in that and would like to see a broader range of jobs indicators, including the JOLTS figure, to show that things are improving. Let's talk about tomorrow's non-farm payrolls. Official expectations stand at about 214,000, very similar to last month's 217,000. Contrary to most months, we don't have a hint from the ISM non-manufacturing PMI. This purchasing managers index of the services sector, non-manufacturing means services, has a subcomponent of jobs, and this usually has a good correlation. The service sector is about 70-75% of the US economy, and this is quite a reliable indicator. Now, this indicator is released only after the non-farm payrolls. But we do have another institution, market, contrary to ISM, which began releasing its PMIs recently. And the services PMI was 61 points or 60 points, if I'm not mistaken, with a strong jobs component. And this is quite promising. Now, ISM has more weight, carries more weight in market, but market is gaining traction, and we should take it seriously as well. In addition, ADP non-farm payrolls released just around 1 hour ago, showed a jump to 281,000, contrary to 205,000. That's only in the private sector, and there's not always a very, very clear correlation between the two, but that's quite encouraging. So I think the real expectations are more around 225, 230,000, a little bit higher. But anyway, let's continue. I think we'll see around even more than that, around 240,000, especially due to the services PMI and the ADP just released now. And if we get a drop in the unemployment rate, it will only be respected if also the participation rate rises. So if basically what I'm saying is the most important thing here is the number of jobs gained. And the unemployment rate is less important as it has been in recent months. Okay. Before we talk about the scenarios, I want to mention again, the Fed is on a preset course to taper QE and finish it in October, maybe in December. So we need a really big surprise, either to the downside or to the upside, to make people think that maybe QE tapering will move. So QE tapering will probably not move at all, but the expectations for rate hike might move depending on the data. Now begin the 5 scenarios. I think because of what I said now, there's a very wide range of between 175 to 250,000. That if we'll get such a number, there will be no chance of any change in the Fed policy, no change in interest rate expectations. The focus will shift back to the next meeting of the Federal Reserve. And for euro dollar, that means that all the attention goes to the Draghi show, to what Mario Draghi said. So basically, the dollar will not be moved. I mean, it'll shake, but not pick a direction up or down. So each other currency is on its own. For instance, the British pound is being strong, the yen not so much. And regarding euro dollar, our focus, it depends on what Draghi says. I think that's the baseline scenario of figure within expectations. I think that even 240K, as I predict, will not, I mean, it's a good number, but it will not shake markets too much. Now let's look at the other scenarios. Scenario number 2, non-farm payrolls beats expectations significantly between 250,000 and 300K. We've already seen 282,000 earlier in the year. So it meets the higher end of gains already seen. I mean, it's at the high end of what we've seen, not something extraordinary, but very, very good data. The dollar is likely to strengthen across the board. Still, euro dollar moves more on Draghi's flute, whatever Mario Draghi says, and less on the non-farm payrolls, but it's still, but in this case, it is a bit more attentive to the non-farm payrolls, and euro dollar would probably be a bit weaker, but more depends on Draghi. Third scenario is below expectations between 100 and 175K. This is back to January's levels. It's clearly a disappointment if this happens. The dollar slides across the board, but yet again, euro dollar still leans more towards Draghi and less towards the dollar. It means that if Draghi is quite dovish, euro dollar could still fall, even if we have a weak non-farm payrolls. But in this case, the dollar will probably slide against other currencies. Now we'll move to the more extreme scenarios, the unlikely ones, the excellent numbers, great success numbers. If we have job gains of over 300,000, U.S. media will begin talking about a sustainable recovery, about an acceleration. Everybody will be very optimistic, and rate hike expectations will be brought forward. Means we might now markets might begin expecting the rate hike in the second quarter or even the first quarter of 2015. The dollar rallies across the board. The focus shifts away from Draghi to the U.S. economy and actually steals the show. As aforementioned, this is quite unlikely. but a figure above 300,000 jobs gained is really, really dollar positive. And to the last scenario, which is the other extreme, a gain of under 100,000 jobs. I don't expect the US to lose jobs in June, but that means that the weak GDP in the first quarter looks already much more serious. It might push back rate hike expectations closer to 2016. The dollar will crash across the board, and euro dollar rallies, regardless of what Draghi says. He will be very disappointed if he'll try to top down the euro while non-farm payrolls are a total disaster. Yet again, this is an extreme scenario. I don't expect this to happen. Not an excellent job gain, not a terrible one. So these are the 5 scenarios. Just go back again to the baseline, 175 to 250,000. Nothing changes, and the focus remains on what we said about Draghi. He'll try to top down the euro, and but non-farm payrolls is a guess, and it can be quite surprising. Okay, these are the other scenarios. Okay, that's it. Now I'm open to questions. What do you think will be the next direction of euro dollar? The next current levels? We've seen that euro dollar is so stable. Do you think there's room for a ride back up to 140 or a crash or just nothing? Of course, I hope we'll see more action, but in which direction? I'm here. Any questions? Is anybody trading euro dollar tomorrow? Well, while I wait, I'll stress that this is a very, very volatile event. Even though market volatility has been quite low, having the most influential event on the euro and the most influential event on the dollar happen basically at the same time is very, very important. It's very meaningful. In addition, US markets, it's the last trading day of the week because of the Independence Day, 4th of July holiday. So towards the end of the session, you'll probably be scrambling to close positions, and this is likely to cause even more volatility. Yes, I think it'll be more volatile, as I mentioned. Non-farm payrolls is the king of forex. Even though the Fed looks at jobs, even though the Fed events are important. So, and for the Eurozone, of course, inflation numbers are important, the German indicators, the ZU, the IFO figures, but the ECB press conference is the number one event. So having them at the same time is likely to result in choppy trading. Do you have any questions also about the British pound, Canadian dollar, or any other thing related to what I presented? I'm all ears. Well, thank you as well. Okay, while I wait for any more questions if they come, I'll say thank you very much to FX Rate, number one Forex portal, for having me and having the webinar. You're welcome to visit Forex Crunch and join the newsletters. There's a daily and weekly newsletter. And here are all my contact details, email address, Twitter, and you're welcome to download the mobile Android and iOS apps. Forgot to write here that there is also an iPad app. It's relatively new. And we still have a few more minutes for more questions. It seems as if the market is already positioned for a stronger USD. Good question. Yeah. After many long days of weakening of the US dollar, we're seeing it make some kind of a comeback today. The expectations, as I mentioned, are now higher than they were earlier in the week for the non-farm payrolls, especially because of today's ADP just 1 hour ago, and also the ISM manufacturing PMI, which was basically good. So I think the whisper numbers, the real expectations, are higher than 214, 215. And they're closer to 230. But basically for euro dollar, if we focus only on euro dollar, if we have only 200K or even 180K, which would be a significant disappointment in comparison to 230, 240, does not change what the Fed is going to do. So, in my opinion, I believe Draghi will have more influence, even if we have relatively weak numbers, but not extremely weak numbers. Yeah, 4th of July is a bank holiday only in the United States. It's U.S. Independence Day. That means the European markets are still open, Asian markets are open, and Canada is also open. Yesterday was Canada Day, Canada's Independence Day. Clearly, from the European afternoon, trading volume is going to be significantly lower. When we have low liquidity in the markets, there's a higher chance of extreme moves because every big order has more impact than it has on normal days. But what we've seen in recent months is that when the liquidity is low in the markets tend to fall asleep. So I'm expecting lots and lots of action on Thursday, and perhaps also on Friday, in the European morning on Friday. But once it becomes Friday afternoon or in Europe, or Friday morning in the US, I think markets will calm down and we won't see extreme moves. GBP, yeah, pound dollar. It had an extreme rally for very good reasons. I've been liking the pound since early in the year. We have a really strong economic recovery in the UK. It's seen in excellent job numbers, strong PMIs, strong growth of over 3% year over year. Central bank became hawkish, even though it zigzagged a bit. But in recent days, the pound really made a huge rally in comparison to previous days. So it might be getting close to overbought territory. I think that 172 is the next line of resistance. Anyway, I would trade with caution. If we do get a strong non-farm payrolls number, it might be an opportunity for a correction. In general, I think the pound still has room for the upside, but it does have room for correction after the very, very nice rally. You can see on Forex Crunch, there's an article, not written by me, but by someone else, called Pause for Thought. So that would give you an idea of my opinions as well about the pound. Yeah, US trade balance is showing deficits for years and years. That negatively affects GDP. But we have to look through the basic snapshot number of trade balance, look at imports and exports. If both of them are rising, it means there's more economic activity in the US. The US is exporting more and importing more, so consumers are buying more. So this is more important than the actual number. If it's a deficit of 40 billion or 45 billion or 35 billion, that's the area of numbers we've seen recently. But it's more important to look at import and exports. And it's not, I mean, if we see under 30 billion or over 50 billion of a deficit, that would be important. But if we see between 35 and 45 billion a deficit, there are more important figures to look at regarding the dollar. EU is still going south. Yeah, I think this ADP report, which was excellent, it's the highest since November 2012. 281,000 jobs were gained in the private sector, according to this private company, ADP. Much, much better than expected, and was released over an hour and a half ago, and it has a positive impact. For basically all currencies, it also provides an opportunity to take profits, especially for the Aussie, which reached 95 cents, I think, and went up to 95.05, and these are a bit high levels, so ADP allows traders to take profit. Regarding euro dollar, I think it's falling now, but I think it'll sort of grind to a halt and remain very, very steady towards the big events tomorrow. As I see it now, it's 136.46. I think it'll stay around these levels. It'll become a bit boring until tomorrow, until the big events tomorrow. Monday, it'll go in an opposite direction. Then on Thursday, euro dollar, I'm not so sure. Well, if we have an extreme move to one side, either up or down, we might see a correction. Yeah, that makes sense. It always makes sense. I don't think. But sometimes moves in the first Asian session of the week on Monday morning in Asia, which is afternoon in the United States and late at night in Europe. There's sometimes a race afterwards in the European session. So yes, we could see that, but we would need, I think, a very extreme move in order to see a significant correction. What about CAD? CAD, yeah. For many traders, CAD is boring. I personally like it. Canadian dollar has been moving up. The big change was in the release of the inflation retail sales numbers about 3 weeks ago. Inflation significantly picked up around 2% after a long period of really low numbers in Canada, and retail sales numbers were also quite upbeat. They showed a big rise in the volume of sales. Since then, the Canadian dollar is on a roll. I think the weakness of the Canadian dollar earlier in the year really helped the Canadian economy. In addition, the crisis in Iraq also pushed oil prices higher and helped the Canadian dollar, but this is less significant than the domestic economy. Another important thing to note about Canada is that it depends more on US demand than on oil. So if we see if the US economy is doing better, usually it's good for Canada, and we see the Canadian dollar rising. 106.60 is an important level there. Next important support is 105.50, but also the round number of 106 is important. In general, I see more room for rises for the Canadian dollar against the US dollar, but a lot depends on next week's Canadian jobs data. I mean, for the next big move in the loonie, in the C dollar. Yellen speaks, if I'm not mistaken, at 11 a.m. Eastern Time, which is 3 p.m. GMT in just over an hour. Yellen is usually relatively dovish. She's always been like that. So, but it will not be a surprise. So if she says we need to wait and see see a broader range of employment indicators improve before we raise rates, it would basically weaken the dollar, but just marginally, because it would not come as a surprise. If she's really upbeat about the economy, then it'll be very bullish for the US dollar. But Yellen, after an initial bump at the beginning, she mastered the art of talking a lot without saying anything, just like her predecessors. So I believe analysts are going to cling on to every word she says. I will follow the event as well. But I don't expect, I think the big show will be left for tomorrow. All right, I think we've run out of time. So it's already 1:45 GMT. So thank you very much, everybody. Hope you enjoyed it. I wish you all a successful and profitable trading tomorrow or whenever else you trade. Thank you very much, FX Street, once again. Thank you very much. And hope to see you all again soon. All right. Thank you very much. If you have any more questions outside of this webinar, my contact details are on the screen. I'll be glad to answer. Thank you very much.